Hi all. Welcome to Search for Yields, the weekly newsletter from INR Bonds. I'm Arjun Parthsarthi. And in this edition, we talk about how Gsecs shine when equities and the benchmark Sensex tanks. It shows that government bonds are a good investment option when there is heavy stress on equity markets during crisis times. So I'll take you through two past examples. One is in the 2008 financial crisis, where as we all know, those of you who have been in the markets at that point of time saw equity markets crashing very sharply, almost 50%. And they took a long while after that for the markets to recover. But at the same time, the government bond yield, the 10-year GSEC yield, also came down very sharply as the central bank cut rates following the US Federal Reserve cutting rates to almost 0%. And RBI too followed and provided a lot of comfort to the market. And this helped government bond yields to fall sharply. And when 10-year government bond yields fall, the prices rise, and investors who have invested in the bond tend to make a lot of capital gains as well, apart from getting higher interest on their investments. So why do these? Why does? I'll also give you another example before I talk about why yields fall when GSEC yields fall when Sensex fall. Thanks. The, the most recent event, which is the 2009, 2020 COVID crisis, where we saw the Sensex falling from levels of 40,000 plus to almost half, not fully half, to 25, went down to 27,000 levels. And at the same time, government bond yields too fell sharply from 6.8% to 5.8% levels, a 1% fall. And that 1% fall means translates into sharp rise in prices of the 10-year set. And again, the GSEC yields fell because RBI cut rates sharply to support the economy and also supported government borrowing through heavy bond purchases, etc. And this helped government bond yields fall very sharply. So if somebody if an investor had invested, foresaw some kind of a setback to equities, and they had instead sold equities and invested in the 10-year GSEC, they would have made very strong capital gains, both in 2008 period and in 2020, the first half of the COVID crisis. But having said that, it doesn't mean that at this point of time, the Sensex will fall sharply or GSEC will fall again, fall from here because the levels of market levels are also different. There are so many other different aspects that you would need to consider, but it's just a point worth noting that typically when there is heavy stress in the financial system, which is telling on equities, then the first step central banks take is to reduce interest rates to keep it down to very low levels. And this helps the government bond yields to fall sharply and also take up the prices, and investors tend to make a big investors tend to make capital gains on that as well. Uh, and After that, the path normally is that GSEC equities recover and GSEC yields also rise as inflation expectations tend to rise. One more aspect why yields fall is because when there is heavy stress on financial system and the economy looks to fall, economic growth looks to fall sharply, inflation expectations to come down as lack of growth brings down prices, lack of growth and demand, and this leads to a better valuation for government bonds. So these are some of the aspects that can help investors look to invest when they're looking at the markets and positioning their portfolios, balancing their portfolios accordingly. But as I said, it doesn't at this point juncture doesn't mean that if there is that there is stress at this point of time or that government bond yields, even if there is stress, can fall sharply from these levels because they are already at very low levels of yields. Thank you very much for listening in to the search for yields, and do follow us on YouTube. And also do not forget to come to our QuickInvest digital retail platform to invest in bonds with the most information, best price, and the more easiest of investment processes. Thank you.